What's going on, everybody? This is Alex from the Stock Operator channel, and in this video we're going to do an account update for this week in December. A lot of exciting news for you guys. Accounts at all-time highs again, and so we're going to go over the equity curve, the drawdown, and we're going to do something a little bit different in this video. I'm actually going to do a market monitor update so you guys can see what I think is going to happen with the market over the next week or two. So if that's something you're into, stick around. All right, so currently the account sits at 132,204. We are slightly down on the day. This was Friday's close, and the 1 month change is around $10,034, up 8.21%. So we're really excited about this performance over the last month. And with that, we're going to get into some of the details. So this is a look at the rate of return for the account year to date so far versus the S&P and the NASDAQ. So we are currently up 32.94% versus the S&P 500 in orange and the Qs in dark blue. So we are nicely outperforming both indexes while keeping our 60-40 bond to stock ratio alive and well. So 33% returns for a 60-40 portfolio, not bad. So this is what the account looks like so far. As of today, the December 5th. So we have about 34% fixed income, 36% in the US small caps, 13% in options, 6.7% in US large cap, 0.77% in cash, and 5.63% in international small caps. And we're going to go over, what's inside of all these with some detail, because actually the options position is a little bit less because we actually sold some calls against some of these options positions to take profit on some of these so that it doesn't get too out of whack, because we want to keep the options around 5 to 7%, but we did really well with those. So just starting with the fixed income, we have the majority of it is in SGov, and we have the STRC, the MicroStrategy preferreds, variable preferreds that are yielding about 10%. In our small cap allocation, we have a basket of diversified names from healthcare to energy, energy in many different facets, whether it's supplying energy specifically to data centers or the commodities themselves. We have some crypto exposure. We have some financials, like this figure is a crypto financial. We have some tech stocks. We have some consumer discretionary stocks. We have some healthcare stocks, and we have some, batteries, power, and also mortgage stuff. This is a look at the options positions, and like I said earlier in the video, we've made good amounts on some of these options. So actually we sold upside calls that you don't see here for whatever reason. This is only the long options. Maybe it's stuck inside this other. But yeah, you can kind of get a glimpse of what we're doing here. We got a lot of stuff in energy, but also we have some semiconductors, some crypto stable coins. As you can see, Circle here. We just bought this copper one in FCX, GameStop, software, Pega, and then CRISPR. So it's a majority energy, but there's some other things mixed in. And as for our large cap holdings, this is Amazon and Tesla. I'm trying to get these to 4% positions each to make the total allocation about 8%. International stocks, we have some lithium play, a power supplier, and then the Amazon of Southeast Asia, SE stock. All right, so with this account, as I said in the beginning of the video, it's a 60-40 portfolio with bonds and equities. And the reason for that is actually to keep the equity curve, in an uptrend. We don't ever want to have it go below the 16-period moving average, as seen here in red. The account equity is in blue. And as you can see, every time it dips below the 16-period moving average, good things don't really happen. So we're trying to keep it above that at all times. And, we kind of switched up our strategy a little bit towards the end of the year because we had a cushion. So we're a little bit more aggressive on the long side. Like, we no longer have puts on the index, and we're not selling calls on every position like we were the majority of the year, to our detriment. But it's paying off nicely. And this is the actual equity drawdown with another 16-period moving average on it. And as you can see, I like to keep the drawdown within 5%. So, we're up 32% on the year. And, besides this April crash, we've generally kept the drawdown below 5%. So that's good. That's where we want to be. So that's basically the portfolio update, the allocation, and how we're doing. For the next part of the video, what I want to do is go into a market monitor update. So I'm going to go into the market internals, the market breadth, what I see going forward, and our plan of action for next week and the weeks following. Okay, so to start off this market monitor update, I like to highlight this. This is the Tom DeMark indicator, and basically showing you guys this spike we're seeing in TD sell. So this is basically the amount of stocks that have gone up 9 days in a row, or not 9 days in a row, but like their close today is higher than the close of 4 days ago, 9 days in a row. So as you can see, the rally is now, 7 days or 8 days old. So, and they started to bottom during the red portion of the cycle. And yeah, we are now starting to see a pop in Tom DeMark, which is actually quite bullish. As you can see in April when we got this little pop after a decline right here, it actually, it led to a massive rally. So these things, it's not like the TD sell, which is a screen, which is akin to like a buy the dip sort of a thing. But this is kind of a lead to momentum in the market. So just wanted to start off with that in the market monitor update. The next thing I want to go over is the drawdown of the actual index. This is the IWV index with the drawdown chart over the last, I don't know, 1 to 2 years here. As you can see in 2024, we had multiple 5% drawdowns, and they were followed by subsequent V-shaped recoveries every single time. And in 2025, we were actually, without a 5% pullback for some time here, besides this massive 20% pullback that we saw here. But this is kind of akin to strong markets. The first pullback is around 5%, and it V's and it goes, sideways for a couple months. So I would expect it to follow the same pattern, or perhaps it doesn't. But we finally got our first 5% pullback that we correctly bought and are up quite substantially on. Okay, and to continue with the market monitor update, I always like to talk about the stage analysis first. This is what it looks like here. Stage 2 is in green. Stage 4 is in red. So stage 2, of course, is stocks that are rallying, that are trending. And stage 4 is obviously stocks that are declining and that are trending. So you can see the green and red lines. And then also the yellow and orange are stage 1 and stage 3. Yellow being stage 3. And so stocks that have rallied and are now going sideways, and stocks that have declined and are now going sideways. And as you can see, how we looked at the drawdown, we had a decline in stage 2 stocks here. And then we had a subsequent rally back up to 40% highs. And that's typically where you see, strong trends is just stage 2 stocks hang around 40%. Sometimes they can get above that, but it typically stays here. Anything above that is kind of extended. And we're seeing stage 4 stocks decline and stage 3 stocks decline. And actually, we're seeing some stage 1 stocks increase, which is ideal. Now, I like to talk about what's inside stage 2 because there's 3 components of stage 2. There's an early uptrend, a new uptrend, and a late uptrend. So, and that's what you see here with the light green, the bright green, and the dark green. So light green is early, bright green is established, and then the dark green is late. And so typically, long-term rallies don't really end without this dark green line picking up higher than the bright green one. So that's why we made that call into this decline, that we thought it would rally, and it would rally pretty sharply, because we're not really seeing, like we saw here in late 2024, early 2025, how the majority of stage 2 stocks were actually late term stage stocks, or stage 2 stocks. And that's how you get bigger declines, because these stocks have finished going up, or they've been going up for a long time. So this rally is actually quite new. So that led us to be bullish into the decline. And as you can see, we're not really seeing a large pickup in late term stage 2, so that's going to keep us bullish. But the longer the time goes by, that number is going to start picking up here. Okay, and on the flip side to that, this is inside of stage 4 with the same logic. The light red, bright red, and dark red for early, established, and late. And as you can see here, we were getting a little bit worried into the decline because there was a pickup in new downtrends. But that has subsequently declined rapidly here, back down to a more bullish level. Now, this could always pick up, but what we really want to see is the deterioration of bright red, early trending downward stocks in order for this market to really pick up some steam. So we're going to monitor that. Now, another thing I want to show you guys is the short-term momentum indicator. And as you can see, in early April, we had this very big spike in short-term momentum. And we're seeing a similar, it's a little bit weaker, but a similar spike, which generally leads to more bullish action. It started to decline here, and a pickup in red. So a slight downward trend because we've already been going for about 9 days here. So pullback is probably in the cards here, but that spike in bullish momentum is typically bullish in the intermediate term. Here's the long-term breadth. I've been highlighting this for every video, but essentially it's very interesting because this market has been kind of muted. It's almost been recessionary, very close to recessionary because it's been close to zero, but it's never really popped below zero, gone into bear market territory. So if this thing actually kind of expanded here and the bull market got a little bit stronger, that would be something that we'd be looking for. This is another thing I like to track. This is 20% bullish and bearish. So stocks that have made 20% moves in 5 days on either side. And we saw a spike in green, 20% bullish stocks recently, and a subsequent decline in 20% bearish stocks. This bearish action that we saw in October and November was kind of it wasn't spiky in nature. So I'm watching for something more serious to happen. I mean, potentially early in February we had something more rolling like that, which could lead to a spike like it did last time. But there was a lot of stocks going down 20%, in October and November. So to see this spike afterwards is a welcome sign. But it's also you got to be cautious because that kind of weakness, that kind of sustained weakness, is actually bearish too. Here's one of the last indicators I'm going to show. This is the correlation index. This basically tracks the correlations of the top 50 stocks in the S&P 500, whether they're all moving together or they're moving separately based on the options market. And as you can see here in November, we got a spike up to about 25. So anything above 20 becomes very bearish. But the fact that it got below 20 here is making us hold on to our bullish stance, even though we're monitoring it and adjusting the risk. Like we're taking some profits on the options positions that moved a lot in our favor. But we're just taking profit and getting ready for more sideways kind of action in the market. All right, and the last thing I wanted to show you guys in this video was just my outline for the IWV index, which is the preferred index that I track. Going into this decline, we made the forecast that we would want to buy the dip into the kind of 5 to 7% range here. So that we hit that nicely, and we bounced subsequently. So just a couple things to note, like this rally off of this red candle is much stronger than this rally, okay, off of this red candle. So it is stronger in nature, which makes me believe that this is going to be a nice little pattern here for the market to break out of. And if I see this here, I'll just draw it like that. So this is kind of a mini little Wyckoff base, similar to what we saw here. Okay, where we had our first initial reaction here, and then another one, and then a last one, and then it went sideways a little bit, and then rallied. So that's kind of what we'd be looking for here. Boom, made a higher high, which is a sign of strength. Boom, here, made up to the new high. Boom, it undercut this level, sprung, very strong reaction, and now we're going sideways here at the highs. So we'd expect this market to continue going upward. And as you can see here, just based on my cycle analysis, and I'm going to just quit those things. So this is the cycle analysis line, or the cycle forecast line of the average green cycle, and we are right here, right around average. We're dipping a little bit below average, which is a little bit worrying, right? Because anytime you kind of dip below average, you should just be cautious. So this yellow might come, but hey, if this continues, we should see a 3.5% return in I think 13 trading days. So we're right on target here for our average green cycle, and then it would look something like this, where we'd break out to new all-time highs, And then maybe in late December is when we start seeing some more weakness. Okay. And with that, that's basically the all the updates that I wanted to share with you guys. I hope you guys had a great Thanksgiving, and I hope you guys have a great week next week. Cheers. Have a good one.